Your RIN TV on-demand video will begin shortly. Meanwhile, be sure to register for RIN TV alerts by clicking on the link below. Bob Stein joins us from the Nasdaq market site in New York. He's been advising leaders in the insurance industry for over 40 years at Ernst and Young. Bob, welcome back to the program.
Thank you, Marisa. Nice to be here.
Let's jump right into results. Insurance companies are reporting 6-month earnings. What trends are you seeing?
Well, you're right. We're into the heart of the earnings season for life companies, and early week results indicate the strength of the headwinds the industry is facing. Many analysts are beginning to mark down quarterly estimates, largely driven by reductions in interest rates and equity markets in the second quarter. This puts a significant squeeze on profit margins in most product lines, and I expect that'll be the tale to talk about during the second quarter.
Any surprises in the results so far?
I'd identify two areas, I think, Marisa. First, while savings product flows and life sales have been somewhat mixed in the quarter, I am surprised at how well they've held up in the face of the tough economic situation in the United States. They're really doing quite well, all considered. Secondly, I'd point to the dichotomy, the growing dichotomy, in fact, between earnings per share growth and the trend in aggregate earnings. Earnings per share are being boosted really significantly by big share buybacks, which, given the prices most life companies are trading at, is a natural thing to be doing. But on the other hand, if one is looking for a measure of the health of the industry, one might look to the earnings trends, which at flat to down during the last several quarters also would indicate the struggles the industry is having.
We hear P&C rates are slightly up, reinsurance rates are down, and life and health rates are decidedly up. What's affecting rates?
Well, certainly commercial and personal lines rates in the property casualty area are up, probably in the 5 to 10% range, depending on the product line. But what's interesting here is we still don't see a lot of that increase in rate making it down to the bottom line. I think we'll continue to see rates rise in the property casualty area well into 2013, largely driven by CAT experience, the reduced interest rate environment, and still very low returns on invested capital. I think we'll see rates rise going forward, but at a less significant rate than we have been in the recent past.
So what are the factors most likely to affect performance in the coming quarter?
Well, for the life industry, it's still the capital markets. It'll be the trend in interest rates and equity markets that tell the tale for the life companies. Slow, steady rises in interest rates and equity markets would be just what the life industry needs. On the property casualty side, it will again be the catastrophe experience during the summer months and the significant rate increases. But again, the real key here will be getting some of those rate increases down to the bottom line. At the moment, these rate increases, while substantial, don't seem to be improving margins.
Bob, thank you so much for joining us.
My pleasure.